Well, there are several actually. There is concern about inflation and the extent that central banks can keep price rises under control. At the same time, investors are worried that central bank attempts to cool inflation by reducing market support and rising interest rate risk, smothering economic growth. Along with heightened geopolitical tension and ongoing supply chain pressures, investors are increasingly challenging elevated valuation and, of course, earning expectation, particularly as prices rise. In bond markets, there is caution too because of worries about the impact of interest rates trending higher. All these factors are leading to an uncertain environment for markets and investors. A multi-asset approach targets a broader scope of investments than a traditional equity or fixed income-only approach and can encompass assets such as commodities, cash, liquid alternative. A path utilizing assets with less correlations with one another can help in targeting a balanced approach to risk, a strategy investors might consider in choppy market conditions. During a period of challenges for equities and fixed income markets, a multi-asset approach allows investors to build exposure to other sectors that may prove attractive, like commodities and alternative beta-type strategies. Gold, for example, has a very low correlation to equities and fixed income and has historically performed well during inflationary periods. Keeping some cash on the sidelines can also help provide a buffer in volatile markets, as well as potential funding to invest in long-term opportunities that might arise at attractive levels. Well, investors need to keep really a close eye on central banks and their attempts to use multiple channels to manage inflation. That means decision on interest rate hikes and possible dialing down of support for markets. Geopolitics and other global issues should also be on investors' radar, specifically the course of Russia's war in Ukraine, the reopening of China after COVID-19 lockdowns, and of course the risk of further supply chain shocks. These factors may continue to shift markets and commodity price. An investor needs to monitor the resulting impacts of those issues on the global economy and corporate earnings. In Europe, the policy response of the European Central Bank to inflation will also be very important for the outlook for Eurozone periphery bonds. Investors can use all these developments to reassess and, where necessary, repositioning their portfolio.